if it's long term, then I'm still a very firm believer of London. You know, I think West End offices are resilient. I think Walter demonstrated the record low vacancy levels. So, you know, where we are in the property market cycle, income is key. So I think prime offices in the West End with strong secure income is still appealing, I think. I think as a sector, the industrial, this last mile fact is very appealing. So if you order something off Amazon Prime, you need it delivered in 2 hours. So all that sort of industrial around the cities, I think, is a good sector going forward. I think the fundamentals are good for all those parcel force companies taking space. And I always think super prime retail is so resilient. You know, you look at Bond Street and it's only so long, and there's so many international retailers demanding and wanting space that I think the rental growth story going forward in that market is quite good.
Okay, good. Makato.
I agree. Central London, I would definitely take a good look at. We're expecting to see some correction in values over the next 12 months, but you know, if you can't wait for that, you can buy shares in listed stocks who have good exposure to Central London assets at 10 to 15% discount from NAV, which I think is good value. We think the Paris market is actually quite good. There's been a lot of things wrong with France, but because of that, it sort of presents good value, especially in non-prime grade B but investment grade stock. Other markets such as Berlin and Scandinavia, notwithstanding the inflation that we've already seen, we think is almost a no-brainer. Very good. And in terms of sectors, I agree with Richard. I think the industrial, last mile, also versatile, multi-let estates. We sort of struggle with the big box logistics, but the more versatile units we think we like very much in the UK and Europe.
Okay, good. Well,
we haven't talked about debt.
Well, now's an opportunity.
I know, but I like mezz debt at the moment. I think it's giving pretty sensible, protected returns, and there's some good managers running mezz debt funds in Europe and the US. So and it's a hot topic, particularly in certain parts of the world like Korea. So quite a lot of money flowing to that, and I kind of see why. Other than that, I totally agree with the guys on industrial. I think as the industrial market matures in Europe, you'll see more of the kind of refurbishment, value add type funds forming here, which there are a few of in the States, and some good managers doing that in the US. And the other one is shopping centres, but shopping centres that have been unloved. I think, as a manager said to me recently, that basically his fund is selling scarcity. You can't recreate shopping centres very easily in the zoning culture of Europe, and therefore, if you've got somebody who knows what they're doing in secondary shopping centres, call them secondary whatever, but they need love, then there can be some very good returns in that.
Okay, good. David?
I think you say it depends on the investment period and the return you're targeting, how much leverage you're going to put on. But I think things we've seen people do recently is to sort of disaggregate portfolios, so buy portfolios and then sell them into local markets and achieve a premium on the pricing. We've seen quite a few people speak to the guys who bought large portfolios of debt because at particular times they will have amortization requirements with their bank, or if they don't achieve certain business plan sell downs, the ICR ratio changes on their loan. So sometimes they're quite keen sellers to achieve those financial ratios. Again, on the debt side, we're doing quite a lot in that space at the moment. I mean, one sort of interesting area we're seeing is people through alternative debt funds funding so-called DPOs, or which is borrowers buying back the loans from people who've bought the loans on a portfolio basis, because they are able to buy those loans back at a discount, because obviously the original purchase of the loans bought it at an even bigger discount. And you lend into that, so you get a good income return and also share in the equity through a warrant. And we're also seeing people like that then actually financing that through their own facility with an investment bank or on some sort of repo arrangement. So I think there's good income return potential outside through that. And again, I was taking a more conservative view. I suppose it would be the more alternative asset classes where there's that sort of locked-in institutional market, possibly one which is slightly less mature, so you hope you get the yield compression as it becomes more acceptable. Although that market is potentially, there's a risk in that market insofar as, when the distortion through QE stops, then that's one of the markets that could be more affected than others in a sense, because obviously it's priced off the margin to.
Okay, good. Pertti.
Anything left? So for me, property is always a long-term investment, and I would split this in Europe, because we're talking about Europe here only. 1/3 UK, 1/3 Eurozone, and 1/3 Nordics. We haven't talked that much about Nordics. Richard, you mentioned already Nordics a couple of times, but why Nordics? Because of the higher yields, generally speaking, and also sometimes easier access to the good stock. Why Europe? Europe is still, the urbanization theme is very much that the winning cities are growing, so there will be a good industrial logistic buildings, also destination shopping centers. They are high on my list, but also residential. That would be maybe something like a conversion type of value added from office to residential conversion type of thing, to have a little bit more spicy on the portfolio. And in UK, not only London city offices I would exclude, but I would go to the second tier cities, not secondary, but second tier cities, and have a good dominant assets from those cities would be very interesting.
Thank you very much. And thank you very much to the speakers. Thank you.